welcome back. Today is Friday, June 10th. My name is Patrick Dunuwila. Joining me today is Steve Strazza of All Star Charts. Steve, how are we doing today?
How's it going, man?
It's going. Another down week for stocks. You know, I was looking earlier. The S&P 500 has only had one up week this quarter. Can you believe that?
Yes.
It's almost over too. Q2 is almost done.
I heard of like a freakishly scary stat today, which was, and this is why stats are fun, right? Like you could bend them in any way that you want. It was like something like the Dow is going to be lower 10 out of the last 11 weeks for the first time since 1920. It's like, oh, so now
since 1920, is that the stat?
Yeah, but like, I mean, listen, you want to take those stats with a grain of salt every time.
Yeah,
they're fun, they're cute, but I wouldn't. They're nothing to trade off of, right?
Yeah, I mean, 10 out of 11 sounds right. Someone's going to have to check your math there, but either way.
Yeah.
So let's get into it, all right? So the S&P 500 fell 5% this week, closing just shy of a new 52-week low. It spent the majority of the week, about 6 days going into last week too, in this tight 100-point range, but we resolved lower yesterday, continued lower today, closing on the lows of the day, lows of the week. As you can see, we're now approaching that VWAP from the COVID lows. It's successfully held twice. Is it going to hold a third time? I don't know. I mean, Steve, typically the more times the level's tested, the weaker it gets, right?
You could say that about a lot of things right now. Bitcoin comes to mind, but yeah. So this is and we saw the Russell 2000 and we saw the NASDAQ 100 violate this level, and then we saw what happened after, right?
Yeah, and that's my next chart. So let's go right there. Russell 2000. This one's a weekly. As Steve pointed out, you know, we've been below that COVID VWAP, and we tried to get over it. Couldn't do it last week. Got rejected this week, and now those 2018, 2020 highs are back in play. And man, Steve, if it doesn't hold those, whew.
I really like this chart. You did a very nice job here. So
thank you.
Yeah, this is what we call polarity, right? Like VWAP aside, if you were to zoom in on this chart, you could see just how important the VWAP is and why we pay attention to it. But VWAP aside, look at polarity here.
And how about how well that VWAP has just been a guide for the whole year? I mean, it successfully held for a while, then it fell and it got trapped under there. Now we haven't been able to get back above it. I mean, that thing has been one of the best indicators to watch for the Russell 2000 and some of the other major indices all year.
Yep. It's a critically important level, always is. So when we talk about the VWAP, the reason for that is mainly because that's what institutions pay attention to. But like, I would even zoom out on this and be like, you know, the VWAP is not the most important level here in this chart right now anymore. It's that polarity coming into play from 2018 and 2020. I mean, if this level doesn't hold, I don't want to know what happens next.
And it did hold back in May. But here we are back, you know, retesting them again. So I didn't have it on there, but we actually stopped right at the VWAP from the 2018 low today. So if you go back and you draw that, we're right there. If that one doesn't hold, then man, like you said, I don't even want to know what happens there. But let's dive into the sector performance. All 11 sectors closed lower. Energy was the best house in a bad neighborhood, but even then it didn't escape the selling. And you know, Steve, energy has just been on fire, even recently too, up until these last couple of days. But, you know, we've been talking and you're saying, you know, you're losing a little bit of bullishness in the energy trade as it's gone. And a lot of those are at major levels of overhead supply where you'd kind of expect to see some pause. So why don't you break us through or walk us through some of these charts?
Listen, it's been a while now, right? The energy has been the sole leader. It hasn't
pretty much all year.
Right. So it hasn't just been that energy has been the best house on the block of a bad neighborhood. It's been the only house on the block of a bad neighborhood. Right. It's been the only place to hide. And I would argue, no, that's not fair. Commodity stocks and a lot of materials names worked up until maybe March or April.
Yeah. Like you had the John Deere's, the Walmarts, even those were breaking out and then all those rolled over.
Right. So we've lost all of that and it's literally just energy. So the way I continue to explain it to clients is that energy investors have a target on their back, right? They're the only ones left. As far as equity markets are concerned, Like that's what the bears are coming after now. And I feel as though that's happening. I think there's some good information that we got this week that tells us rather than the rest of the market catching up to energy, it's probably going to be that energy catches lower to the rest of the market. I would look at this chart as a good example of why that is. Listen, energy stocks are back to where they were before the financial crisis. This is a generational high now.
And you got to imagine there's probably a lot of dead bodies up there. So, if we don't if this isn't the peak, then at least maybe some consolidation around this level.
You're going to listen, if you don't get some backing and filling here, that's super bullish. That's always great. When the market doesn't do what you would think it would do at a certain level, that's always great information. But it's my opinion that this is a perfect level for energy to stop, pause, consolidate, and probably turn lower and show a period of corrective action.
Yeah, I like what you said there. Like if it just keeps going, then this thing's probably going much higher.
Right. That'd be great. Here at this point, using the weight of the evidence in terms of what other stocks are doing, I would say there's a higher likelihood that this chart pattern that looks like a very nice base here probably fails. And that doesn't mean it's going to fail. It means it's going to fail for now, right? So how that corrective action looks will be the next piece of information. If we just go straight sideways and flatline here at that nice base, we're probably going to resolve higher, right? But if we get a nice correction lower, maybe that was it for energy. That's not the bet that I'm making. I think we probably go sideways for a while, but I think for now, energy is ready to cool off because, again, if you're a seller in this market and you're looking for opportunities for the first time in 3 years today, because I went back and looked, I saw XLE pop up on my bearish options flow scan. I haven't seen options traders put that big of a bearish bet on the Spider Energy sector ETF since like 2018. So, I think the writing's on the wall. The rest of the stock market's weak enough. It would make sense to see energy follow. At this point, we're at a very key level. I think you also want to watch like the oil services if you go to the next chart. Yeah. Like a key level.
Yes.
And they've been the laggards, right? So
within energy, you're saying oil services are the laggard within energy?
Yeah, no energy stocks have been laggard. Okay. Oil services are the laggards within what's the leaders, right? So explorers and producers, the multinationals, they've all done really well. They continue to do well. We're seeing the refiners do really well. Recently, crack spreads are at record highs. I think you need to watch oil field services. The reason why these stocks are critically important to the energy sector is because they create the things. They help make the wells and the offshore drilling sites that are needed for energy companies to continue to operate and grow, right? So there's always great information in these stocks. They've lagged the whole cycle. And when I look at this chart, this is the iShares, it's a Spider Oil and Gas Equipment and Services ETF, XES. It's at a critical level. Momentum is waning. It looks like buyers are losing their aggressive nature. And what a perfect level or a logical level for prices to kind of roll over for a little bit or consolidate for a little bit. So that's where my head is at for the whole energy trade right now, is a little bit sideways or corrective action is needed here.
Yeah. And last thing on energy, how about that breakout in ExxonMobil this week? What was that breakout to 20-year highs or something like that? All-time high?
It's good.
All-time high.
So that's one of those charts that we can show in like one of two ways, right? We could show the breakout materializing, or we could show like a nasty failed move materializing.
Yeah, maybe a failed move is kind of in percolating, right?
Yeah, I think so.
All right, so let's move on to US dollar and 10-year yields, which, we've called it the wrecking ball of the stock market this year, just putting a lot of pressure on risk assets. And man, what a stick we had in the dollar index this week, right?
So if the chart in the upper pane that you are referring to goes higher, that would very likely put a fork into energy. I think, right? So energy and energy futures, not just energy stocks, but the commodities market, right? Whether it's gasoline or heating oil or natural gas or crude oil, have continued to trend higher in a very orderly fashion. When the dollar moves higher, that puts pressure on commodities because they're denominated in dollars. So I think if the dollar is to reestablish a new higher range and break out of the 7-year base here, that might be, what needed to kind of.
Just to play devil's advocate, I mean, the dollar strength this year hasn't mattered to commodities at all. As you said, it should, but it hasn't. I'm always skeptical to put too much faith into correlations, but maybe we do see that correlation break down. I mean, that's totally possible, right? We could see a scenario where a stronger dollar actually does mean commodity weakness. Yeah.
I think markets are not dumb, right? Look at this chart in the upper pane here in the dollar index. This would make for a major breakout. And as a CMT, that would be a technical breakout, and you would have to anticipate a fresh leg higher. If you're going to anticipate a fresh leg higher from here for the dollar, I would think, okay, commodities did their best to combat a rising dollar for the past year and a half, 2 years now. If the dollar, or the dollar index rather, DXY, as we're looking at in the upper pane, is going to reestablish a brand new higher range and break out from this very long-term consolidation, I think that's when you're going to start to feel it. I don't think they're not going to take any prisoners at that point. These stocks will probably fall victim too.
Yeah. And I think it's even more telling that this is coming after a retest, right? It already broke out to those highs, the dollar index, but then it retested and you didn't get much on that pullback. I mean, here we are right back towards those highs again. So that to me just means even more bullish for the dollar.
I think the dollar index goes here.
So, Steve, there was a ton of talk about the yen this week and how it relates to interest rates. And I know there's a lot of macro fundamental going on there as far as how the yen relates to the 10-year yield and just interest rates domestically and abroad. So do you want to kind of walk us through that and why yen weakness kind of points to higher yields?
Yeah. So it's all about the BOJ. That's the Bank of Japan, right? So the Bank of Japan has dug their heels in here, and they're trying to cap the domestic interest rates at 25 basis points.
In Japan.
Right. And in order to do so, Japan is, I think they're the largest purchaser of U.S. Treasury bonds. Everybody thinks it's China. I'm pretty sure it's Japan. So in order to have more capital for the Bank of Japan to buy Japanese government bonds, JGBs, they have to stop purchasing so many U.S. Treasuries. So if demand starts to dry up from Japan, who's a major player in U.S. Treasury markets, if that demand disappears, then Treasury prices go lower. Bond yields or Treasury yields go higher. Mm-hmm. And that's why these charts are so correlated.
I mean, they really have been moving like in lockstep all year. I mean, go even further back than that, but yeah.
Yeah. I mean, listen, this is one of those relationships where it's like, we want to pay as much attention to it as possible and give it as much credit as we can and follow it until it breaks. I would say it's similar to like cryptocurrencies and stocks today, right? Like it is what it is for now. Maybe it's not going to be like that a year from now, but until that changes, let's use this information. So like what did the Japanese yen tell us over the past week or two? It's that interest rates in the US are going to resolve higher.
Yeah. And, to your point about the dollar index, that being a multi-decade breakout and really having to pay attention to that because it's such a long-term breakout. This was 20-year highs in the dollar yen pair. So, this is a major breakout too. And I guess what you're saying is that's pointing to higher rates here and abroad.
Yeah. The 3% level on the 10-year, so critical.
Mm-hmm. All right, so let's end it with crypto, right? Bitcoin and Ethereum, we're breaking some key levels today, breaking to new lows. Ethereum seemed to be the one talked about a lot because those were really fresh lows, and we're under that 1725 level that you have here, and really just pointing to further downside. I don't see any major support until those 2018 highs, which for Ethereum, I think is around 1,400 or so, about 15% lower, which for crypto, that's not that much of a leg lower. I'm not saying it has to stop at the 2018 highs, but you'd expect some support there.
Well, I mean, here's the thing, right? When PayPal and Zoom and DraftKings and a lot of other quality growth stocks are down 80, 90%, Bitcoin's down 50%. We call that relative strength, right? And when we just zoom out and look at the absolute price charts, we've talked about US equity markets and the damage that we continue to see in equity markets over the past few weeks, past few months. It's all about completed tops. Another top is being completed and, drafting to the downside. Continues to happen with the best stocks, the worst stocks, the entire stock market. When you look at the major players in the cryptocurrency market, you got Bitcoin and Ethereum. They refuse to resolve lower from these tops. And to your point about Ethereum, that's called a shakeout. Okay. Listen, if price shakes below that 1720 level, that's fine. We see it all the time. Okay. I'm not going to bet on a lower resolution. Bitcoin has held up for 4 weeks, 5 weeks now, while the broader market has been under pressure. Actually, the S&P and the major indexes in the US and the growthier stocks resolved lower from short-term continuation patterns this week. Bitcoin held up. To me, that's bullish information. The fact that cryptos are remaining this resilient in an environment where stocks are getting hit, that makes me think, okay, maybe something's here. This is about as risk on as it gets. Don't be confused. This is not an inflation hedge. This isn't a safety trade. This is Bitcoin and Ethereum we're talking about. They won't break down from their tops, unlike most stocks. So to me, that's not only something that I know I tweeted on Twitter today, like I'd rather be in Bitcoin than stocks. That was a little tongue in cheek. I think the fact that Bitcoin is holding up so well is just, straight up bullish information. It speaks to risk appetite.
I mean, is it holding up that well though? I mean, I'm surprised to hear you so optimistic on it.
Well, it's easy to be relatively optimistic in this market, right?
You're saying on a relative basis, it's holding up well.
Listen,
and that's information, right?
On an absolute basis, most of the places that I look right now, most of the charts that I pull up right now are distribution patterns, really ugly topping formations that are resolving lower. Bitcoin looks like a top, but it looks like a top that is refusing to resolve lower for now. Right? No, go back to that chart. NASDAQ and Bitcoin. That's my point.
Yeah, I mean, for the longest time, those two were in lockstep, and we've kind of seen them decouple a little bit, but they're kind of still moving similarly. I mean, you have a risk-off day like today, and both fell.
Listen, I could play devil's advocate and say, hey, look, when the NASDAQ bottomed out in May, right, you could see it in this chart and rallied higher a little bit, had that little relief rally. Bitcoin didn't go higher. But guess what? Past few days, now the NASDAQ is resolving lower again. Bitcoin's not going lower. So I think there's a lot of information in crypto right now. And that's exactly, what I'm going to have my eyes on this weekend.
Yeah. Like I said, even if you're not trading this stuff, it's definitely still of value to keep an eye on it because they have been trading similarly. It's a good proxy for risk assets right now. So I'm thankful that we have it to watch over the weekend while the equity markets are closed.
There are large cap growth stocks that also trade on Saturdays and Sundays. That's what Bitcoin and Ethereum have turned into. They're simply, an extension of that large cap growth trade. And we get to have information from them all week long. So let's take advantage of it.
All right. Well, good stuff. Steve, thank you for sharing your thoughts and these awesome charts, and hope you have a great weekend. Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week. Thanks.